Earlier on Street Smart, we talked about the potential government shutdown if Republicans and Democrats cannot reach agreement on how to trim this year's budget deficit. Well, two more battles are brewing beyond that one. First up, what to do when the debt ceiling is reached in mid-May, and second, how to cut next year's budget deficit. So what should investors do as the battle lines are being drawn? Joining us to talk about this, Mitch Eichen. He's CEO of the MDE Group, which oversees more than $1 billion in assets. He says investors now cannot afford to be long stocks without hedging those assets. Mitch, good to have you here on Street Smart.
Thank you, Carol.
So with a government shutdown possibly just a few days away, what does that mean for investors?
Well, Carol, we see a three-act play right now playing out on the world stage. The first act is going to play out between now and Friday, and that's about the 2011 budget deficit. Really, both sides are trying to just gain some political advantage. And to the extent that the government actually does shut down, it's going to be about who takes the blame for shutting it down. Now, that's going to lead into Act 2, which is the extension of the debt ceiling, which is going to play out somewhere in the middle of May. Now, that's a more high-stakes game because to the extent that the debt ceiling is not extended, everybody is very concerned about the effects of default. And I don't think either side really wants to see default. But depending upon the outcome of the first act, that's going to depend who gets advantage in the second act. And the Republicans are trying to get a lot of concessions to extend the debt ceiling, and the Democrats don't want to give them. Now, depending upon the outcome of that act and who gives the concessions and who doesn't, that's now the big act is coming on, and that's really the 2012 debate on the budget deficit. And the Republicans and the Democrats are teeing this up as a central issue for next year. So the question is, why does it all matter? We have today a $14 trillion national debt. That works out to $47,000 for every man, woman, and child in this country. Now, the average wage earner in this country only makes $38,000 a year. So it's absolutely unsustainable.
So wait, I'm going to break in because we get it. We're here at Bloomberg. We cover this kind of number, you know, every hour here. So what's then the point for investors in terms of what they should do with all of this potentially playing out?
The point for investors is you can't take the near-term trend in the stock market. Your previous guest was talking about the stock market has a way to run. You can't take the near-term trend and extrapolate it out ad infinitum. The deficit has a huge amount of risk, so we take a risk-first approach to investing. What we see is a set of new market realities, and the new market realities are going to be very middling kind of growth for an extended period of time because the deficit has such a huge overhang. So we see kind of mid-single to high single-digit growth, but we're going to have ongoing volatility punctuated by periodic crisis. So that means we have to take a risk-first approach. So how do we handle that? What we've done is we've actually eliminated about 2/3 of our long-only equity holdings, and we've replaced it with a strategy that we've created called planned return strategy. And what it does is it implements in a separately managed account, which we custody at Fidelity with complete transparency and complete liquidity, an ETF hedged strategy. So we buy a long-only S&P ETF, and then underneath it we place a put spread, which guarantees that over a 12-month period, no matter what happens, the client will not lose money if the market's down from 0 to 12%. If it's down 13, they'll lose 3. If it's down 13, they'll lose 1. If it's down 15, they'll lose 3. But on the first 12, it's free. On the upside, however, they participate at twice the return of the market, subject to a cap. Last year, the strategy returned about 10.6%. The caps will run anywhere from between 8 and 12% on average.
So it won't outperform necessarily, but it's not going to underperform is what you're saying. That's the bottom line.
It will not underperform radically. When the market's going up, you will make a high single to low double-digit return.
But if the market's going up 25%, you're still going to...
You get stopped out. You'll get stopped out at somewhere between 10 and 12%.
So it's the downside protection you're getting here is what
you're saying. But you're getting consistency because it's really a function of whether you believe on a consistent basis the market's going up 25%. We don't believe we're going back to the 1980s or the 1990s anytime soon.
Although it hasn't been a bad run since March 2009. Let me ask you, though, Mitch, about the problems with this kind of debt. And I mean, you can't honestly think it's going to go away if we're fighting about $7 billion here to shut down the government. Are they going to really agree on a plan to get rid of $14 trillion in debt? It's unlikely. So the question is, when does this huge debt overhang actually affect the market? What's the impetus for a market drop because of this huge debt that we're going to live with?
At the end of the day, we're going to fix this, or the markets are going to fix it for themselves. I mean, if we take control of the situation now, we can fix it at a time and place and in a manner of our choosing. If we don't take control of it, the bond market's going to fix it for us. Everybody's greatest nightmare is a failed Treasury auction. Let's not forget.
A la Greece, you mean?
A la Greece.
But it hasn't happened, and everybody keeps talking about it.
Because we keep kicking the can down the road, but you cannot kick it down eventually. Eventually, the Chinese are going to say, I want more money before, for the money I'm lending you. And this has huge implications, not only domestically, but relative to foreign policy.
We have to run. Mitch, thank you so much for stopping by. Mitch Eichen of MDE Group. Mitch, thank you.
Thanks for having us.